When the yield curve has inverted, first of all, it doesn't happen too many times. If you believe inflation is going to be here, you can go to the bank right now, borrow money for 2 years at 2 and change %. You can go buy all of the goods at the supermarket that will not expire in the next 2 years, stick them in your basement. And if you believe inflation is going to be 7% a year, you have an arbitrage. You can go borrow money and then you can resell them in the open market at 14% higher. That's the simplicity of nominal GDP, which is the average price move of everything happening in the economy in terms of the dollars exchange. Nominal GDP is true dollars exchange. It's way above 3-month bills. We're not going to have a recession until that number gets down towards 1%. We're never going to have inflation like the 70s again because of this factor of having the computer be a dominant portion of our life. So for everyone who's scared of it, right now is the time to be fading the inflation fear. We're going to make peak inflation for the rest of our lives right in this period right now, in my opinion.
Hey everyone, thanks for watching this episode. If you enjoyed this episode, make sure you like and comment below. And to find future episodes in your feed and push notifications, make sure you subscribe. And if you click the little bell, you'll get every new episode as it's released. Thanks again for watching. Today, I'm sitting down with Jordi Visser. Jordi is the president and chief investment officer of Weiss Multi-Strategy Advisors, which is a $4 billion hedge fund firm with an innovative investment process of using insightful data analytics and cutting-edge thought leadership. Today, we discuss Jordi's market views on inflation, interest rates, the recent yield curve inversion, and how it may or may not lead to a recession over the next year or two, as well as his views on Bitcoin. So with that said, let's dive in with Jordi Visser. Hey guys, I'm going to take a quick pause to introduce the first sponsor on the Jay Gould Show. I am happy and proud to say that this show is now sponsored by Withum, Smith & Brown, which is a forward-thinking, technology-driven advisory and accounting firm that is committed to helping big and small companies be more profitable, efficient, and productive in today's complex business environment. Withum now also has a dedicated crypto and blockchain technology team to help early-stage businesses properly navigate all the crypto tax-related matters. I've been using Withum both personally and professionally for nearly a decade for all of my business's personal needs as well. I'm very happy with them and I highly recommend Withum. You can contact Withum by visiting their website at withum.com. Now back to the show. Jordi, welcome to the show.
Thanks, Jay. Good to be here.
All right, before we start, I don't usually do this in the beginning of a show, but I want to tell everybody when we're recording this because we're going to talk about the markets, and we don't usually talk about markets on my show. It's mostly about Bitcoin and stuff, but it's all interconnected, as we know. Today is April 25th. It's about 11 a.m. The market's down about 1% today in the S&P, and I think we're down about 12% from the recent highs of November. So that's just giving people context of when we recorded and what we might be talking about.
Yeah, there's a lot of weakness today.
Yeah, the weekend was a little crazy. So Jordi, I recently heard one of your podcasts on the Weiss podcast, and I think you said, quote, if we continue to yield negative rates in real terms, the Fed is still being incredibly accommodative. It seems to me that there are two opposing forces kind of in the world right now. On the one hand, we have these negative real rates, which is favorable. The proverbial kind of textbook says that when you have negative real rates of interest, one should maybe own a quality pool of assets that are cash flowing. S&P is a reasonable example of that on balance. However, on the other hand, the cost of capital is rising, which is unfavorable. So as the risk-free rate is of cost of capital is rising, and the cost of capital largely through the system now is rising, then the value of the cash flows from these companies on the S&P should be worth less as the cost of capital rises, thereby depressing the multiple earnings one would expect. So a few questions here. Let's start with, if these two forces are generally accepted as truths among investors in the market, which truth is true today and why?
Well, it's a good question. And I think to start, let's just go back a little bit and talk about, when we talk about markets and we start getting into things, one of the things I like to do, because I'm an analytics person, but I also care about the environment. In fact, we're 2 weeks away from the Kentucky Derby. I spend a lot of time this time of year on it, and I just did a podcast on it last week. But if you were racing, a mile and a quarter, and then all of a sudden you change it and you said, we're going to race 2 miles today, all of the analytics that you would have would be off. So one of the things that you mentioned about just kind of the cost of capital where rates are, the reason, and I know we're going to talk about the yield curve, the number one thing
Sure.
for me is the change that's happened in nominal GDP. We have become, as people in the markets, fixated with the concept of real GDP, which is just nominal GDP less inflation. We have a
Mhm.
much more volatile inflation situation right now. And we haven't seen it like that since the 1970s and the early 80s. So when people talk about what they expect for negative real rates or for positive real rates or just negative yielding debt, the problem is we have a completely new environment, in my opinion, and people have to adapt to it. So I don't believe we're in a 1970s style inflation. I know we're going to get into that. And so the way that I've talked about on the podcast and the way that I firmly believe in like the back and forth between recessions is that the stock market is like parimutuel betting, meaning investors have narratives for what they think the market cares about. But we just came out of a period from 2009 to 2021 where we produced over 15% a year stock returns.
Yeah.
That's what people should be more focused on. We've had an excess kind of bubble situation, and we need to get out of that because we pumped a lot of money in. So I'll just say that nominal GDP is a different environment. So what you brought up, the back and forth is going to continue for the next 4 to 5 years, in my opinion.
So I guess a follow-up question is like, is there like a red line or a line in the sand maybe as to how high you think the Fed could go without the markets getting hurt? Or do you think that the markets all are like, why aren't they dropping yet?
Well, right now the Fed's only tightened 25 basis points.
Yeah.
So do I think there's a line in the sand? Yeah, but let's leave the Fed out of it because right now people have expected and built in a lot of tightening by the Fed. The way that I look at the relationships between the stock market and the bond market is what kind of yield you're getting from stocks, which can be created from taking the PE of the S&P, which is about 22 right now overall, doing one over that for an earnings yield, meaning what are you receiving from owning stocks? And right now, you're around 5% off this year's earnings forecasts. Investment grade bonds, which were yielding 2 and change last year, are now up to 4 and change. So all of a sudden, for the first time, and I'm doing a webinar on this tomorrow, the relationship between stocks and bonds in terms of the risk premium or how much you should want to own stocks or bonds, they're about in line. Meaning right now it's about the right time that you should be buying investment grade bonds with the move higher we've seen in yields relative to the risk in stocks. And that's why I think we've started to see the shaking. We either need rates to come back down, and I'm talking about long-term rates because short-term rates haven't moved yet, or we need earnings to come through in strong fashion. Now, I think earnings are going to be good this year, and I think we're at the peak in rates. So if you want your first kind of thing, I really do think we're at the peak in rates, and we reached exactly the point that you're mentioning, which is how high can rates go? I think investment grade yields have gone high enough that they're going to start to bring money into bonds and out of stocks. And as we sit here today, we mentioned where the stock market was. Well, the bond market's having one of its best days of the year today.
Yep. Yeah. Actually, a buddy of mine was shooting me over the futures last night on it. It was popping. Yeah. All right. So for the audience because I have a Bitcoin audience for the most part, that's unaware of your background, it's my understanding that you're more of a macro guy, as you're kind of describing, data driven. You look at a variety of macro indicators like housing, demographics, energy, supply, demand. So as I understand it, you're not really more of a sector guy. If I'm saying that wrong, correct me. You've been more bullish on energy and financials, it seems, from the things I've heard. Energy has been a great call. That you're kicking butt on that one. Financials hasn't been working so well. Do you anticipate that this weakness in the financials, did you anticipate this to be a weakness in the financials? Did you see this coming? And what makes you think that you might still be correct on financials if you still believe that?
Well, at the beginning of the year, the biggest, I think relative to what I expected, the biggest surprise to me was how aggressive the Fed jawboning got. It started really in January, and I think from my outlook stuff from the end of last year, yeah, I did believe inflation will be higher and be structural, labor shortage, a whole bunch of things have worked out. But what I didn't anticipate was that the Fed would basically be instructed by the White House for the most part with an unprecedented statement in the first 2 weeks that the Fed had a job to bring down inflation. And so we've built in more tightenings than you can imagine. So the yield curve flattened. Banks, because of a recency bias of the last 10 years, have suffered whenever there's been a yield curve that's flattened. Now, I still think financials are going to do exceptionally well this year and going forward. And the reason is because as we'll talk about, a yield curve is not something that people should be freaking out about. The yield curve, in the way that I look at it, is still extremely steep, which we'll talk about as well. And that's because financials do better in a higher nominal GDP world. So people have focused on what has traditionally been when there's a flattening yield curve. Nominal GDP is coming down, and nominal GDP is still near the highs since the 1970s. And so that means loans are going to be happening. Asset valuations with houses and stuff like that allow for people to go borrow money. And there hasn't been a lot of loan growth from 2009 to 2019. And one of the primary reasons is because the housing market was effectively unchanged until 2017 or 18 from the peak in 07. And so the banks have tailwinds behind them. But during the biggest surprise that caused the underperformance was definitely the Fed being more aggressive. And that's where I was surprised. It also, the other place where I've been wrong this year is thinking that the dollar would weaken, which has implications to your audience in terms of Bitcoin, because when the dollar's weakening, Bitcoin typically has got more of a tailwind behind it. So Bitcoin's been hurt by let's say the Fed being incredibly aggressive with their words this year.
So what would be the credible bear case to make you rethink the position on financials then?
A recession. And again, that's where the biggest debate for me with everyone is that we're not going to have a recession. So that's the thing that would change my view.
Okay. Similarly, as I understand it, you're a pro-cyclical guy, meaning you like cyclical value. What other cyclical sectors have been underperforming your expectations? And can you help me understand why you believe that you've maybe just been early and not wrong on that?
Well, one of them recently, I'd say home builders, but I didn't really spend a lot of time on home builders this year. They've underperformed recently in the last month. Transport's the same thing. They've had a nice bounce recently. But to be honest with you, this is not that big of a surprise to me, just because if the analogy I'll give is we're in a period of 2004 to 2008 for me, which was one where commodities were in a bull market. There was a rotation out of technology. One of my strongest calls has been that overvalued tech would continue to go down. That's probably been my best call of this. Yeah. And I continue to believe it. It should be good for your audience, because one of the things that it's doing and helping is bringing more talent and more money into crypto, blockchain, Web 3.0, more excitement. I think we're in a 4 to 5 year period of tech multiples coming down sharply, the private equity market having trouble on the tech side. And so all of these value cyclical names to me are in a bull market relative to tech. Right now, we're just seeing a correction with the materials names and the energy names coming down. But that's what's necessary to keep these cycles going and to keep recessions from happening. The only two ways I could see a recession happening this year were if the Fed got overly aggressive, and they're not going to. They're talking it. They want inflation to come down. And the second point would be that I believe oil is going well above 300 over the course of the next 5 years. If it happened this year, we'd have a recession. If it happens in 5 years, people will be surprised how strong the economy can be with oil only going up from 100 up to 300 over 5 years. With it going up 20% a year, it's not a big deal. So those are the places I've been wrong and some of the places where I've been right.
Jokingly, so you think that 500 PE ratios are a little crazy?
Yes.
I mean, some of this tech has been out of control, right? All right. So can you tell me some other examples where we've had inflation rates this hot that we're seeing now, and we've actually been able to get to a soft landing? Today, like the gap between the Fed funds rate, which is currently, like you said, 25 bips actual, right? Yep. And then an 8% plus inflation. It seems like we got a soft landing in 94 is my understanding, but there wasn't this much of a gap, I don't believe. So how do you think about the potential collateral damage impacting financial markets from like even the Ukraine war that's started now in the ordinary course of events of a military conflict, assuming obviously we're not heading into like nuclear action or something like that. So basically, how do you think about how much this may or may not challenge your bullish thesis? Because it seems that this may be incremental from when you first introduced your call on the S&P being up by the end of the year.
Yep, and I'm still going to say the S&P is going to finish up at the end of the year. But here's the way I'll bring the conversation back. And you brought a lot into that question, particularly with bringing 94 into it. So a Fed tightening cycle, the inflation side. So let's start with something I said on nominal GDP and where money is. So right now, 3-month bills are 80 basis points. Nominal GDP year over year is about 11 and change percent right now. So the differential between 3-month bills and nominal GDP is above 10%. When we've had recessions, or going into recessions, like when the yield curve inverts. And I'll just give you the points because everyone, that was what really triggered our conversation was the yield curve inverts. You had heard some of my stuff, and then we exchange information. So
Yeah.
when the yield curve has inverted, first of all, it doesn't happen too many times. So you go back over the last 40 years, maybe you get 5 times. Nominal GDP or 3-month bills less nominal GDP, or nominal GDP less three-month bills, has historically on average been around 1% when the curve gets inverted and we start going into a recession. So we're right now at 10%. We're almost 1,000 basis points above. And the argument that I make for everyone who's not an economist, if you believe inflation is going to be here, you can go to the bank right now, borrow money for 2 years at 2 and change percent. You can go buy all of the goods at the supermarket that will not expire in the next 2 years, stick them in your basement. And if you believe inflation is going to be 7% a year, you have an arbitrage. You can go borrow money and then you can resell them in the open market at 14% higher. That's the simplicity of nominal GDP, which is the average price move of everything happening in the economy in terms of the dollars exchange. Nominal GDP is true dollars exchange. It's way above 3-month bills. We're not going to have a recession until that number gets down towards 1%. Now, could it happen? Yeah. The other thing that's different is we have the unemployment rate, which is down and continuing to go lower. In the 1970s, when we had a similar inflation period, and you have to go back to the early 80s to the late 70s, you were dealing with double-digit or higher unemployment for much of that. We don't have that. That's why they had a misery index. Instead, you've got a completely different scenario. And this is the way I want to break it down. And these are the kind of analytics that I use in my Derby analysis. So the Atlanta Fed releases a bunch of inflation data, but they have one called core flexible and core sticky. So during the 1970s, the core sticky number basically stayed very, very high and really never got below 6%, and it got as high as 15.5%. Right now, the core sticky is 4.55%, way below where it was in the 70s. What is higher now and is driving it is something they call flexible. The flexible one, and these are the ones that can actually move around because of supply disruptions, that's currently at 18% right now in the US. It never got above 11% during the 70s, which means that what's driving most of the inflation in this country is related to bottlenecks. The bottlenecks are not completely easing at this point, but people have to remember when you avoid a recession the way we did in 2020, and you shove that much money into the system from the government and the Fed, you get an explosion of demand. Supply has not caught up with demand even yet. When it does catch up to more side through a combination of demand slowing down because of fears over the stuff that we're seeing and prices going higher, you'll start to get things in more equilibrium and the inflation rate will come down. I'm going to give you one buzzword that you can use or go through, Jay, which you probably haven't heard. The Fed funds rate peaked basically in 1981. It went down sharply into 82. Paul Volcker was given a tremendous amount of credit for fighting off inflation. So in 1982, he was up for and thought to be possibly the Time Person of the Year. In 1982, the Time Person of the Year was a personal computer. And I've always said that is what caused the inflation. We're never going to have inflation like the 70s again because of this factor of having the computer be a dominant portion of our life. So for everyone who's scared of it, right now is the time to be fading the inflation fear. We're going to make a peak inflation for the rest of our lives right in this period right now, in my opinion.
Yeah, I brought Jeff Booth on my show. If you know who he is, he's the author of The Price of Tomorrow. So basically, we have this deflationary environment that's happening. In fact, we're just buying growth through all the debt, is what he's arguing.
Yeah, I'm a believer in Moore's Law and exponential innovation. And Web 3.0 and the blockchain is more powerful than anything we've seen because it's global. It's a borderless internet, and that's going to have huge implications 3 to 5 years from now. It's not today's business because it's going to take a while, but it is sucking in talent and dollars every single day, and it's coming from the fiat system. And so the fiat system will continue to move money into this incredibly powerful, innovative side, the next wave. And so when you say Web 3.0, and you really think about it, this is the most powerful deflationary force we're going to see. And more importantly, in my opinion, few win in the most recent Web 1.0 and 2.0. It's been the reason that we're fighting inflation right now because the bottom end is suffering. But in the new world of crypto, many win, and that's a very different story than before.
So we'll get to Bitcoin in just a minute. That's my next follow-up after the next couple of things. But I'm going to talk about the yield curve that you just talked about. You know, some parts of the yield curve, as you said, have inverted, and they reversed quickly to that point. Many people believe that this is a strong indicator for an incoming recession, as you said. But history kind of tends to show, I think, as you were indicating too, that the shorter end of the curve, like the 3 month, the 3 month, right, for example, better predictors of a more likely recession in the relative near term. And some people argue that any yield curve inversions that we're experiencing today or in the future may not be as predictive of a recession, mostly because of like the disruption of liquidity in the treasury markets by the Fed's increasing positions in bonds along the yield curve. I guess the question is, do you feel that the yield curve inversions are less of a recession signal now than ever they have been in the past because of this, or does this not even weigh into your thinking about them purchasing bonds and owning them more today than they ever have in the past, disrupting the liquidity in the market?
Here's the way that I'll say it. I find it to be insane that people look at 10-year bond rates as an indicator of anything, and I'll tell you why. The way that I think about 10-year bond rates, if you go back right now, 15 years, the iPhone came into existence in 2007. To borrow money in 10 years or to use 10-year interest rates as an expectation or anything, no one could have imagined the changes that we would go through in the deflationary forces. So time is speeding up. And so like you watch an NFL football game right now, the rules have changed. So if you're thinking you're going to have a 10-3 game with the quarterback not throwing 50 times, it doesn't happen anymore. So the nature of technology is just much faster, and with this innovation going much at a faster pace, you can't do this. The oil market is the perfect example because it used to take a decade to find oil, get it out of the Gulf of Mexico or even the Atlantic Ocean. Eventually, maybe it's taken 20 years. So you had to go borrow money on the long term. But then fracking came, and we were able to get it like that, and it was push button. Everything in terms of innovation is speeding up, and that just means that I don't understand the concept of 10 years. And I'll just put it faster. I mean, I've got 4 kids. They have no intention of living in the same town for 30 years and showing up and punching their card and leaving. They're mobile. They're all over the place. And so why would a 30-year mortgage make sense to a kid? This whole concept of long-term bonds are just useless. And I've said it not recently, but I don't think there'll be bonds in 30 years. That's how much of a technology believer I am. I think once the blockchain dominates our life, and I know I keep going back to it, but it fits in the macro context. And I don't see a lot of people that are macro thinkers that put it in there other than trying to make money off of it. I actually view it as very disruptive. And so when the Dow Constitution example pops in and I go, well, there's a situation where you can go borrow money almost overnight, a large sum, which used to be the amount an early stage investment in a company would get, and it can happen overnight. Isn't that 5 years from now going to be a more disruptive force? So why do we need to go borrow money in 10-year bonds to build a company and then go through this? I just don't see it happening.
I had the benefit of meeting Garrett Camp. He was one of the co-founders of Uber many years ago. Yep. I was at a bar in San Mateo, and his ride left, and he was talking to me, and he's like, "Oh shoot!" He's like, "Can you give me a ride back?" And it was like it's a funny joke. I have a running joke. I was the first Uber driver, right? But he was telling me on the ride back that even then he sold StumbleUpon.com for about $80 million to eBay. And I was running my startup, and I'm asking him all these questions. How did you get in front of Meg Whitman? Blah blah blah. And I'm just grilling him, and he's texting like, "Jesus, God, this guy." But I always say that was the reason why I needed an Uber driver. I don't want people, it's like they know too much about him. We're just grilling them for information and stuff. But he had this thesis even then that people won't own. He didn't own a car. Even then, he did not own a car. He's like, I don't see the point in it. And I jokingly said, you needed one tonight. But this is before the Uber. This is like 06, right? Yeah. So years later, the iPhone comes out, and then he creates the first Uber cab app. And but the mindset was own nothing, right? Yeah. Rent. And so it's like, you're right. The movement is moving towards, towards technology and deflationary kind of environments and stuff. Yeah. I do have one last question, and then we'll move into the crypto space here. Last question before we move over there is, it's not only the U.S. that's having this inflation thing that we're seeing. Obviously, it's kind of a global phenomenon. So, like, how much of an incremental risk is there of a soft landing in the U.S. as we are now likely seeing a rise across the world of interest rates? I mean, we just saw Canada jump 50 bips, right, to combat inflation. So, like, the forces of rising rates, really not a domestic dynamic per se. It's like global at this point. Also, I guess at that point, like, can we absorb the ripple effects of that, globally, if they're raising the rates, as there's a tightening globally happening, what kind of ripple effects will that cause?
So again, you have to get into what the central banks are trying to do here. This is not a Paul Volcker situation where inflation has persisted for 8-9 years. every central banker knows one thing for certain, which everyone listening knows and everyone should know, which is we had a pandemic. It shut down a tremendous amount of things. I go to Maine 60 days a year, and I know a lot of restaurant owners. I know a lot of hotel people. They still don't have any labor, and part of the reason they don't have any labor is because they get an influx of people from Europe on the East Coast that work in the jobs during the summertime. They get a lot of people from the islands, the Virgin Islands would come up to work in the hotels when they open. And we just didn't have any of this last year. We've had supply problems because of the bottlenecks due to COVID. Not just the shipping, but it's been a labor situation. And every day it's getting a little bit better. And so the central bankers know this. They know that they have to fight the expectations because inflation is a disease that historically, once it sets in, it gets people really scared and they think, oh, I lived in Brazil in 1997, 98, and part of 99. And when I moved down there, the suggestion to me on things that I needed for my apartment, it was a refrigerator, it was a dishwasher, it was washer and dryer. And then the last item that I had to have was a meat freezer. And the reason was because they had hyperinflation back in the late 80s into the early 90s. And so buying meat, you wanted to hoard your meat, stick it in a freezer because it would be more expensive that day and the next day and everything else. We're not in those periods right now, but the central bankers know that money's too cheap. They want to get rid of the expectations. I think you're going to have a dynamic that's very powerful. We needed the market to go sideways. So for everyone who's out there, I still do not believe that anyone for the next 5 years should be over owning technology stocks. I think the multiples, not just on the companies that are trading, as you said, at a 500 PE, there's a lot of companies that have benefited because of the lack of competition from the globe. And right now, where you don't have crypto impacting investments for the next 5 years, Bitcoin's not going to impact the oil usage we have right now. You can't change ExxonMobil by sticking the blockchain into it other than making them more productive. It's not a disruptive force. Anything with middlemen who's on the service-based side will be disrupted. I think the central banks are just trying to get ahead of things, and right now we're in a very different state. But I think you'll have a different story by the time we get to September. What's happening in China right now is the dominant story for today. It's the reason the markets are down. The lockdowns that are happening in China because of their zero COVID strategy, which is under attack. It's forcing China, and we might have in the next week a Beijing shutdown. If we have a Beijing shutdown, you're going to have more people worried not about inflation, but about deflation. And right now, that's why bonds are up today, because people are starting to shift. So today was the first day that we saw the cyclicals down sharply. Tech was up on the day before we came in here, and you had rates down. And that just means the market is starting to build in that inflation is going to be lower 3 to 4 months from now, which I think all of your listeners will be able to go back and say, I think we'll have lower inflation fears 4 months, 5 months from now.
I live on the Jersey Shore, so we go over to Seaside Heights, New Jersey, and they have a lot of Eastern Europe folks that come over in the summer as well. So you're right. Last year, it wasn't as many of them when you went over there wearing your mask and all that stuff, for the last couple of years, I should say.
And wait, one thing I think it's important, Jay, just so people know that dynamic in Maine, and I will tell you, capacity in a hotel is down like 40 to 50% in most of them. So when you don't have as many rooms, the prices in Maine last year went through the roof. So you're filling out what you can do. In New York City, I'm 4 blocks from a bunch of hotels that have completely shut down. We had a lot of business closures. So when people hear about an upcoming recession, I didn't say this before, but recessions are good for the economy. What they do is they get rid of inefficient businesses and they let new productive ones come in. I'm a Jets fan. I don't know. You're in New Jersey. I'm a New York Jets fan.
I'm not a Jets fan.
Okay, well, good for you. But I've been in a recession for a while, and we cleansed the system. We got rid of all the players. We traded everything, and now we've got the draft coming up this week.
Ever since Namath.
Well, no, we've actually been in kind of a low growth area for a while. I'd rather have the 0 wins, finish last a bunch of times, trade the good players, and then end up restocking. And that's we ended up having those. So I really do believe that what happened was a lot of supply issues, which are going to come back in the line, and then you'll be left with lower inflation, and everyone's going to have a job, and that's where we are right now.
This leads me to some follow up on this one. So How does the raising of the rates by the Fed and the central banks fix the supply chain issue? If we have supply chain issues from the COVID lockdowns, which has caused the inflation, and you raise the rates enough to fix the supply chain issues, aren't you likely to cause a hard landing? It seems that the central banks intend to contract demand, which will negatively impact the growth in earnings. I don't understand how that's not going to cause a recession if they do that.
Well, that's why they're not. I mean, if they were really concerned that this inflation was sticky, they would have raised 100 basis points at the first.
Right.
They raised 25. So, the supply, they understand the supply issues need time, but they also understand that politically and kind of psychologically, expectations of inflation being stickier going higher. So they need to show that they're going to fight inflation and at the same time, hopefully get enough time to where the supply chains will actually start to ease up. You've already seen a softening in the housing market as prices have gone higher, and as the supply chain has caused this to happen. You've seen the housing market soften up. The restaurants, we have a lack of supply, but everything kind of goes through it. The Fed just wants time for this year, so the supply chain, if it doesn't get better by the time we get into 6 months from now, you'll probably start to see them pick up the pace of tightening, because they actually believe at that point they're probably going to need more of a recession, and that's the dilemma.
Yes, it is. It's really interesting though, because they raise the rates, right, and the housing gets impacted first because mortgages go up. So it's like I tell people all the time, if you're looking at $100,000 house at a 3.5% interest rate, it's like $460 a month or something like that. If they raise that to 7%, which looks like we're getting there pretty quickly, the 7%, you'd have to drop that price of that house from $100,000 to like $75,000 or something like that, mortgage rather, to $75,000, something like that. That's a 25-30% correction in the market that could happen if you have the rates double, right? I don't know if you agree with that or not, but it seems like the first thing it impacted would be that, because it's a direct correlation.
Yeah, so at the beginning, if you remember, you asked where do rates start impacting the stock market, and I said we're right there. Again, if rates come down a little bit and if the earnings come in, it's a relationship of not just rates to the multiple, it's to time as well. We had such a fast move higher in rates that it caused problems. In the housing market, 30-year fix went above 5%. So you're still extremely favorably priced to where we got in 07, 08, or at least 05 to 07 in terms of the housing market. But people extrapolate the most recent moves and the speed of them. And so they expect that this is going to continue. And so everyone's fear factor starts to fit in. You get a softening of the market. So
it seems that a lot of people may or may not know this. Obviously you do, but like the bond market and the debt market, like it's just way bigger than the equity markets, like by a magnitude of what, 2 or 3x? I'm not exactly sure, but it's in dollars.
It's actually what's happened in the US globally. The bond market is still a little bit bigger than the stock market, but you have to remember that the equity markets have gone up a ton in the last 12 years. So what used to be true before 2007, bonds really couldn't do much because rates were already low. And then you had obviously the negative move we've seen here. I think in the US, we're about the same now. You're not going to see, and again, if I'm right about the lack of bond needs, high yield for the rest of the year, I think is going to have a shrinkage of debt outstanding. And for IG, we're front loading a lot of it, and then you're going to start to see things come off. A lot of the more tech gets in, you don't see a lot of debt for tech companies. So this has been a changing environment for a long time. It's the physical companies that deal with the physical world that were the debt users. We've seen debt decline while Amazon went higher, and Apple does have debt, but for a lot of these companies, they don't have any debt. So.
Yeah, and I guess what I was saying is that it seems like the credit markets move a little bit faster, maybe because of the depth of the market, but that's, I guess, is changing. But I was just wondering why equity hasn't dropped as fast as the bonds have gone up in the further out in the yield curve.
Oh, in terms of bond rates?
Yeah.
Well, remember, and again, so that spread that
or yields, not rates, but yields.
Yeah. So what I talk about in terms of so far this year, spreads have not widened out that much, which means that when rates were going higher, we were going. For a while there, IG yields were going up about the same pace. They were 2 and change last year, and even with a 25 PE on the S&P, you were still dealing with a very large differential of over 200 basis points between the earnings yield and IG yield. So unless we have a recession, that just means stocks are cheaper than bonds. Now that we've seen yields go higher, that relationship is about 100 basis points, which puts it back to where it was before Lehman. So that's why when I do talk. I expect stocks to be up this year, but if you ask me what the S&P will do the next 5 years, because I think tech is going to continue to underperform, I think you're going to get 6 to 8% a year returns for the next 5 years. That's down from 15 and change. So you're talking about a big decline, and with inflation moving higher, real returns on stocks just don't look as attractive. I also don't think bonds are going to give you that much, but that's where I am a little bit more negative than probably what people realize. Where I do think you will continually get good returns to outperform inflation is in financials, it's in energy, it's in materials, it's in industrials, it's in parts of the market that have a PE closer to 10, which means they have an earnings yield of about 10. Tech's PEs are much higher.
I've been saying to people for years, a lot of my friends, it's like, don't try to beat the market. If you're an individual investor, they just buy the indexes, and they all talk about SPY. I say buy VTI for this particular reason, which is you have the entire S&P 500 the entire US stock market rather in VTI versus the S&P 500, which the S&P 500, as we both know, is largely driven by these tech companies. Yep. And they're massively overvalued. So if there's a rotation out and it goes into small cap and it goes into value, there's more of a benefit, at least I thought, to be more of a benefit to be in VTI because it encompasses the whole market, and will, on balance, it'll kind of move over that way. You might get hurt in the S&P, but maybe I'm wrong about that.
No, yeah, I mean, you're right. It's still, those companies are so big that if it's cap weighted, it doesn't really matter that it's the entire market. I mean, to give you an idea, MSCI World, which is the global benchmark for pension funds, of who I spend most of my time talking to, right now, MSCI World is over 60% the United States as a stock market. I mean, we're 15 to 20% of the global economy, but our stock market is about 60% of the overall market. For as well as we've done here since 2009 in our stock market, I don't think people know this, but MSCI World X the US is down since 2007. So we've been in this bull market for stocks, but the rest of the world has not. And the main reason is the only place that's really had a bull market since 2009 is technology, and it's really been the US tech names. That's why it's such a dangerous thing for individuals and pension funds to not look at their portfolio and understand that they are positioned for a period of disinflation, and we're in a period of higher inflation. And so technology is very overvalued because the expectations where we'd be in deflation or disinflation. People need to make adjustments to their portfolios. And I think the private markets and these innovation names that are on the public markets are showing the same thing, which is their valuations are coming down. I don't think that's going to change for at least the next year or two in terms of the overall prices of them. I think they're still coming down.
I was going to ask you about the private technology market. I'm an angel investor in about 100 companies, mostly early stage. So there's growth ahead of them regardless. So it doesn't matter if the valuations change, they're growing. They'll grow into it, right? But the later stage stuff I also do. I got into SpaceX a few years ago and some others, and the valuations are just off the charts. I mean, at the last value they just had on a secondary transaction, of course it's a small transaction, but they valued it at $170 billion, up from $100 billion like a year ago, and like $40 billion 2 years ago. I mean, just going through the roof. Based off of what I don't even know for SpaceX, But so what do you think about private technology? I'm sure you're looking at the secondary markets a little bit peripherally. What do you think of those valuations and where we might see them over the next couple of years?
So this is, I would say, the most unloved of my views, because it generally has been where people have made most of their money, either in the technology sector or in the private markets. And when I say most people, it's individuals in tech, but it's also endowments. It's I won't say pension funds because they're not necessarily the same one, but anybody that's involved.
Aren't they LPs in the VC firms?
They are.
They get some exposure.
They get some, but not as much. Like endowments have been dominated by this area for sure, and the private markets in general. So my view on that side is there's three things going against it. One is you've probably seen some of the public, the companies like SoftBank, some of the hedge funds that have been helping these valuations because they've been taking in more money and they've been involved in it. They've had some problems in their public market returns, and that's going to cause losses, which will make it very difficult for investors to put money into it. So the first one is that you're getting losses, and Losses usually in this kind of contagion perspective, if it's structurally related from a macro basis, they keep going, and I think it takes a long time. So I have viewed the public markets to start as being in a 2001-ish bubble that is now going through a process where it needs to unwind, and it took 6 years for that to occur. The problem with this one and what happened back then was the other thing that hurts is if rates are moving higher and if inflation's staying higher. And that's what's going to happen. So, on an environment perspective, with higher inflation, with rates moving higher, that's the opposite of what we saw whenever all these valuations went up, which was from 2009 to 2021 even. The third part is what we're going to segue into, which is I don't think people fully grasp the disruption that is coming from Web 3.0. I view Web 3.0 as being a global borderless internet. Having all of the VC money in the United States, basically from 1990 to 2013, then China started getting some and they became part of it. But China and the US dominated the last 10 years. But before that, the US had a stranglehold on VC money and they had all the talent and it was all in Silicon Valley. Well, now everyone has an iPhone. Everyone has a supercomputer in their hand. You're seeing startups and all kinds of blockchain innovation happening in Latin America, in Africa, in all these places. And when stuff happens like to Facebook, versus TikTok, and TikTok has a disruptive part on their business, which is a Chinese company. And then you've got Spotify, which has got their own thing as a Swedish. You're seeing competition come from around the world. And that just means that the complacency that usually sets in that we have the best and brightest in the United States and we're creating all the innovation. Historically, when you get to that point, you're underestimating the competition that's happening. And I just think the competition is going across the globe, and it's much easier with the blockchain. The barriers to entry are going down and the cost is going down sharply. And so if that's the case, you've got a big issue. And then the thing I talk about with a lot of people in New York City is what drove a lot of the innovation in the US is we were taking the best and brightest from around the globe and they were moving into the colleges here and then spending the time in Silicon Valley. Part of the regulations of the U.S. government have made that more challenging, but then also the ability of people to do it outside of here has made it easier. So I just think that all in all, the private markets have about three headwinds that are structural, they're persistent, and they're going to have a hard time on being able to keep those valuations where they are. And I think the way I've described the early stage to late stage, whatever the time period was from early stage to late stage, whether it was 3 years, 5 years, 7 years, I leave that up to people like you that have done it. In crypto, I've watched my son go from having $700 in his crypto wallet at one point to 80,000. This stuff happens it happens in a lot faster. So Axie Infinity was one of my favorite stories for last year. And you go look at the growth and you compare it to something like Fortnite, you're talking about things that can go from very small to massive in a period of quarters, not years.
Yeah.
And that just means early stage to late stage is much faster. And I think the US has to adapt. And I don't think VC funds are going to be able to deal with that to the way that they think they are.
Yeah. It's interesting, why this, I have a thesis around this, why this is happening and why it happens rapidly. It's kind of what you said before, the speed is happening faster and faster. And it's because we have the social web now and a social graph. So things can pop off very quickly just from word of mouth, the way you share it on Facebook and all the different various platforms, YouTube, et cetera. Just things catch on way faster than I did 20 years ago. I mean, just the world's connected more than ever. It's like the world is flat kind of thing.
But that's
I want to move over to Bitcoin.
Before you go off, I've used this a lot. I really think if people would just spend the time on how quickly Fortnite, 4 years ago grew. My son, all of his ideas on tokens came from Reddit. And so the speed of social media and the ability of him to know more than me, I'm sitting in front of a Bloomberg terminal all day long. And even though I'm not fixated on crypto, I kind of consider myself pretty well informed. I can't keep up with him in terms of his ability to find things that I haven't seen about. So he's giving me information. So to your point, I do believe that the social platforms have allowed this to go much, much faster.
GameStop's a great example. I had Howard Lindsay on my show earlier last year, and he was describing how he made one of the first investments in Robinhood, $1 million, grew into $100 million unrealized, sold 20% of that in a secondary transaction. I go, what, you don't believe in this? And a few months later, the GameStop debacle comes in. I go, wow, you really predicted that one. You got a little lucky. He's like, I got lucky. I had no idea. He was just trying to get returns, real returns for his LPs. But the fact that that could happen so quickly on these forums and stuff, I got to tell you, when I started my career in the internet 20 years ago, there weren't even blogs really. I mean, some people did it, but they didn't call them blogs. You know, it wasn't a thing. It wasn't until, I guess, Ev Williams, the founder of Twitter, created blogger.com, and it really kind of popularized it. But today, the world is flat. Information is freely democratized and available for everybody. And it's just an entirely different world today. And the growth of things can happen in a nanosecond. I mean, I had a friend last year who was telling me about Bored Apes. We're about to get into Bitcoin and talk about this stuff. But he's begging me to do this drop. I laughed at him. I'm like, buying a monkey picture? What is this guy crazy? He got 100 plus on the drop. And he still has over 100 of them. It's incredible. I mean, and then on top of that, he gets like airdropped all this other crap. So it's like for like one $400 investment, it's worth over $750,000 per.
Yeah.
You know, it's incredible. So like that's just a whole new dynamic that just didn't even exist a few years ago that exists today. I don't encourage people to be buying NFTs and any of this kind of stuff because I do think what that stuff is much more Ponzi-like. I think that what you're kind of describing, which is the kind of, they call it the Web3 stuff, which I really believe is just the internet. We can get into that in a second. It's just a new version of like the internet. It's like Web 1, 2, and 3. I don't really think it has anything to do with Bitcoin. So let's talk about Bitcoin. I want you to describe to us when you first heard about Bitcoin and why you're bullish on Bitcoin. Like, what is it that was your aha moment? Because to some people, it takes a while. It takes like 7-8 touches. And then they're like, wait a second, how did I not see this before? So like, tell us that evolution of understanding of Bitcoin.
Yeah, it's a good question. And I haven't been asked it. It's why I like doing these where I get to take my macro. I've been involved in markets for over 30 years. And so whatever is happening with Bitcoin, it was, okay, when is this something that I should pay attention to? And the reason is because simply of the hype cycle. When you're involved in markets for a long time, you see tech hype cycles. And usually when guys are coming up and talking about it at cocktail parties and they're bragging about how much money they went, that's usually when I first hear about these things. So for Bitcoin, truly, the first time that I think I heard enough that I paid attention was really 2014. And I think that was when the people that I know are always involved early in these things and kind of creating the hype, they were there and they were talking about it. So at that point from 2015 really into 2017, I started paying attention. I started reading more about it. I wanted to understand. And to be honest, at that point, it was no different to me than looking at little plastic 3D printer things and going, okay, this is something that could be part of our lives, but there might be another disruptive thing that comes in.
Yeah.
This is not the first digital currency. So I got to be honest with you. I was not too enamored with it in 14. And by 16, it was clearly a bubble. And I just said, okay, I don't care about it. The blockchain I do care about because I see that as a very powerful thing in terms of bringing authenticity. And I see the need for the blockchain. Then in 2018, 2019, I really wasn't paying as much attention. But I would say this, people that I knew were smart, even after the massive fall, they were still involved in it and telling me to pay attention. And that got me more interested. That reminded me of kind of the way hype cycles go. You get the hype, you want to see if it can survive. And so I'm like, all right, you know what? The next time that I see this thing going again, I'm going to pay more attention. And that obviously really started at the depths of 2020. And I started really talking about it because when Bitcoin started to rally first as an asset, it had made it to my screens as an asset. And then when it led, and Bitcoin did lead the stock market and everything coming out of the bottom, I thought, okay, MMT is here. The government's going to print as much money. This is one of the reasons that crypto should be gaining speed. First, it was, came out only a month after Lehman Brothers in terms of the white paper. I knew the history of it at this point, so I was really interested. And then coming out of COVID, it made sense to me that it should go higher. I started to buy some in that period, and I started to spend more time kind of going through pension funds and talking to their views. And by the end of 2020, I wrote a paper basically saying that Bitcoin was now officially an asset. Insurance companies were buying it. I talked to them. So I was now fully on board with crypto as an asset. But in 2020, everything expanded for me. NFTs were a major thing for me, not in terms of, as you talk about the artwork or any of that part. It was really, I started seeing the utility function was showing up, and more people that I'm really impressed with as entrepreneurs were getting involved in it. And they were talking differently. Mark Cuban, Kevin O'Leary. I started really listening to podcasts. And then around the third or fourth quarter of last year, a person I respect just said, hey, I know you're doing all this work on NFTs. you got to go start paying attention and put it in the context of Web 3.0. I think it'll shape your macro views. And so in a period of September through November, I must have consumed 100, 200 hours worth of podcasts, YouTubes. I did a little bit of reading, but I really focused on how I thought it would reshape the world. And I'm convinced that NFTs of last year, the movement, and it just is, it's driving people to the space. And I consider it the year of the App Store, which was really the most important part of Web 2.0 because it brought the excitement, it brought the developers. It's taking talent from the bigger companies, and I think it's just going to continue.
So I, as an investor in the private markets, I have a basic litmus test that I do. It's called DSD. Is it differentiated? And then you look at the founders. Do they have the ability to scale this with their go-to-market plan? So is it scalable? And then if they do, is it ultimately defensible? Is there a moat of some sort? What's the barrier to exit? So barrier to entry, can you get to scale? Barrier to exit, right? For customers or users or whatever that may be. That's my basic thesis. And on Bitcoin, I've been trying to, and crypto in general, I'm trying to figure out, because I believe that Bitcoin is the one truly, the true digital currency. I figured I created this thing. I want you to play this way. I created this thing. It's called the Frisbee disk test, right? Disk standing for decentralized, immutable, scarce, and censorship resistant. And when I throw this back and forth, when people say, "Oh, I'm looking at Solana, I'm looking at Ethereum," I say, "I'm going to throw you the D. Is it decentralized?" You give me the answer back. They come back at me, and then I say, "Is it immutable? Can it be changed?" Right? And then they throw it back. And is it scarce as a result of that, right? And then ultimately, this is the most important part, if it's a store of value, right? Yeah. Is it censorship resistant? I don't find anything else out there that passes that test other than Bitcoin. Everything else, that's why I said before, it's basically just another company, right? They may say they have foundations that are running, the Ethereum Foundation or whatever it is. But ultimately, the government could shut these things down. They could seize it. So to me, that's not a real store of value. It's not like gold, right? I have on Clubhouse, the drop-in audio app, I created the room called Digital Gold, right? For Bitcoin. And we talk about Bitcoin on there. So basically, I just kind of like throw things through that. And this Web3 thing, to me, it's just like, these are internet companies. And there's nothing wrong with that, right? I love internet companies. I'm a founder of 4 exits, so like, I love the internet. And it's all good. Like all my Bitcoin maximalist friends would say, that's all scams, Well, is it a scam? It's a scam if they're saying it's competing with Bitcoin. Then I would say that they're right. But if they're just saying it's an internet business and we're using a distributed database, which they're calling a blockchain, it's not truly a blockchain in the sense that Bitcoin is a truly decentralized blockchain. These others, I don't believe, are truly decentralized. It doesn't mean that they won't exist and won't create a lot of value, though, right? So you could see some of these NFTs for skins on users in different games and worlds, and all this stuff is going to evolve. You don't see something like OpenSea go to $3 billion in monthly transaction volume and just go to zero. It's not going away. That's not disappearing, right? It's gotten really big, really fast. When I say that, does that bring anything to you? Do you understand like what I'm saying? And how do you think about the decentralization of all these other chains and or crypto Web3 project?
Yeah, so I had to answer this question, obviously, to a lot lesser degree than you just explained, because you got to think about it. When I'm on the phone with most people and I'm going to say my world, because there's the crypto world, sure, where there's a ton of religious people that know ins and outs of all this stuff. And my son knows a lot more, like I said, than I do in some of these things, at least some of the tokens. And then there's the people I deal with on a regular basis. First of all, I'm 55, so my age bracket, very few people are in any way not believing that crypto is a bubble. Like they don't even want to have, for the most part, don't want to be involved in it, unless they're with a tech background. Pension funds, they're trying to learn, but for the most part, they have like zero investments in the space and they don't know how to do it. What you said, I'm going to convert into the language that I say to them, because I agree. Number one, I view Bitcoin as the bank account for the Web 3.0 economy. So I'm saying Web 3.0 is a new economy that competes with the existing fiat system and the physical world that is based on few winners. And so in a world of many winners, and again, the disruption, if you wanted to rebuild Uber as a blockchain company, there's been a lot of things written on this. You can do it as long as you can get safety inside the wallets. And I think what you said, Jay, the most important thing, if you view Coca-Cola and McDonald's as companies that you don't worry they're going out of business in a year, tech companies can be disrupted and be gone very quickly. And so to your point with other parts and other protocols in the system, other things, Ethereum, can Ethereum, lose their advantage? Of course they can. So you've got enough going on over there where I view it as money and talent is going in this Web 3.0 economy globally. When they make money in it, part of it's going into Bitcoin. Bitcoin is the bank account of that system, and I think it always will be, partly because of just the OG side, partly because of the dynamics that you mentioned, but part of it is because of the
established history.
Yeah, and I think it fits in with the way Warren Buffett tried to buy businesses. So Coca-Cola not going out of business tomorrow, so why not move your money into Coca-Cola? If you took all of the companies in the US that are here, that you don't have to worry about them going out of business tomorrow, that's safe money. It may be boring money, but it's safe. As time goes on, I think Bitcoin's annual performance will continue to go down, meaning it was 60% last year.
Yeah, of course.
And Ethereum last year was up 400%. That gets back into that's the technology speculative side. And I view Bitcoin as the OG kind of stable thing that is the bank account of the system.
I say this all the time. A lot of the friends I have in the Bitcoin space will be on Twitter Spaces or Clubhouse or podcasts like this, and they'll reference things like Bitcoin has gone up 200% historically since inception. I'm like, that's since inception. Nobody mined or bought it and held it the whole time, other than Satoshi, maybe, right? Like, let's be real, right? That wallet didn't move, but like most of the people have traded in and out and lost Bitcoin essentially, right? I think the moving forward performance is more like over the next 5 to 10 years is between 30 to 60%. You don't really know, right? For the CAGR.
Yep.
And that outperforms probably most things, if not everything, just like it has done in the past. But there will come a time over the next 10 to 20 years where there are other things where the OG Bitcoiners that you're describing that are sitting on large amounts of Bitcoin, 10, 20, 50,000 Bitcoins, they're going to say, there's an opportunity cost for me to continue to hold this now. I should trade some of this in because I see other opportunities in the market that I can divest into, right? Yep. And I think that's coming over the next 10 plus years. I don't think it's happening anytime soon, which is actually a problem for the growth of Bitcoin because there's a large concentration. 19 million full Bitcoins are held by 100 million individuals, they estimate. So we got to encourage them somehow to get rid of it. That brings me to my last question, then we'll wrap up, which is, do you envision the SEC ever approving an ETF? We saw one approved up in Canada, and I actually had a conversation with the folks that were a part of that. Sean Cumby was the guy, and and they got it approved. It took a while, way longer than he thought, even in Canada. But we're having issues getting this approved here, and I think this would help NGU number go up, which would help as the number goes up because people just click. Bitcoiners hate this, by the way, because there's no self-custody of Bitcoin, right? And we all believe you should self-custody your Bitcoin because of the censorship resistance, and I think that's a valid concern. What we're seeing, what they're doing with Russian oligarchs and stuff. I mean, in the world we're living in today, you really want to own something, and the only thing you could truly own, really, even your stock portfolio, everything could be seized, right? Yep. Bitcoin's the only thing they can't take from you, although it's volatile as hell. Right? So yeah, just follow up on that if you could.
Yeah. First of all, yes, but I'll tell you what has to happen. It's going to happen. The reason I'm on podcasts, or part of the reason that I believe Bitcoin between now and the end of the year will double, is because I think it fits exactly into what needs to happen for there to get approval on this. And that is the fact that individual investors, I spent a lot of time with RIAs, they're not doing anything in this space. The major wirehouses, they don't have a view on crypto or digital assets. And if we have a year the way I expect, let's assume the S&P finishes the year up 7% total return, which would mean about 5% in before dividends, and the tech names are down on the year. Well, that means a lot of portfolios with bonds down, because bonds will be down this year, stocks barely up. Individual investors are losing out by not being able to invest in the space. So we haven't had one of those years yet. We haven't had one of those years where crypto separates itself from technology, which it's been doing so far this year to some degree, much better than people realize, because there's certain innovation stocks like ARK, which is very popular with retail investors, with innovation names, where the public names are not doing well, but crypto has outperformed. And even the crypto names, the Roblox, the Coinbase, they're performing horribly, and the digital assets are doing well. So I think what you need a lot of individual investors to be complaining. I don't know if you've spent time there or with people there, but with the movement that's happening in Wyoming, which is arguably the digital capital of the United States. From a regulatory basis, the movement that's happening there with, I forget the senator's name, but she is
Cynthia Lummis.
Yeah, I was in Wyoming for a conference, and I met some people out there, and they just talked about the way she feels about it, how strongly she feels about it, and what's happening inside Congress, I just believe that people are underestimating that there are sponsorship inside of there. What you need is a reality that people are like, hey, you're preventing me from being able to invest in something that I want to invest in. And that's going to speed up the process. I really do believe it needs a year where technology stocks are not doing well and crypto is doing well. And that'll bring more focus to it.
I got to follow up one last question. I'm sorry. It's a very quick one, but the fact that like Michael Saylor was basically, I saw him on a podcast with a friend of mine, Scaramucci was on recently. It was Mark Yusko, Scaramucci, and Michael Saylor. And I forget the name of the podcast, but they were on a crypto podcast. And it was a funny clip actually. So Scaramucci says, I'm long Bitcoin, and Saylor leans in and goes, "You're not long enough." I was like, pause, man. But it was a good clip. And he goes, "Listen, you're long, but you only have a small percentage." He's like, "I'm in 500%. I borrow money to buy Bitcoin." As a fiduciary of a public company, do you think that this is irresponsible of Michael Saylor and what they're doing at MicroStrategy? The amount of Bitcoin exposure that they have, I mean, they're basically a proxy to Bitcoin. It's almost like an ETF for Bitcoin at this point. Do you think that that's irresponsible? Or what are your views on the fact that he's doing that? And do you think more companies will add to the treasury over the next several years?
All right. Is it irresponsible? I don't even know how to answer that, just because with inside the constraints of the public market, yeah, I would say that that's probably, it's probably maybe a little inadvisable. If you want to be a sustainable public company and be involved, be a part of indices and stuff, it's not there. Do I think that he's getting a lot of publicity for it and enjoying a lot? Yeah, he's getting a lot. And, again, go back to the Kentucky Derby. Mattress Mac has done this thing for the last couple of years, and he's going to do it again, where he's basically offering people the chance to get some of his merchandise, and I'm going to go bet $3 million, and he affects the odds of the race. It has to be factored in the handicapping. So I think Michael Saylor, I've enjoyed his stuff. He's a very, very interesting guy in the interviews that I've heard on the podcast. We're at the early stage of me being convinced it was an asset. He's a very, very strong thinker in economics and has a history of GDP. So I think he's doing something which I agree it's going to work, but as a public company, I don't think it's probably the best way to run a public.
Yeah, and the only thing I say about it, I don't think it's irresponsible in my opinion, but the only thing I just don't know what I don't know. And so like, if this thing takes a huge leg down for whatever exogenous event that could cause that, what would happen to his company? I guess he would have to start unwinding, or they'd go bankrupt, right? Because they have all this debt. Now they have term debt, right? Yeah. So it's like 5 years. It would have to be a sustained downturn of some sort. So I'm sure he's probably fine. If you believe that we get on the other side of this, which I do, it seems like you do. I guess the risk is upon maturity, would he be able to raise more debt to be able to, satisfy obligations?
Yeah. So I'll tell you, I'll give you and as we get to know each other, my brain works in a very weird way when it comes to analogies and stuff. I can't remember exactly where MicroStrategy stock was, but I believe it went down in 01 to 07. It went down a ton. Okay. Apple went through this at some point too. And even though what he's doing is basically levering up on, let's not say Bitcoin, let's just say the new technology, because he's betting on the ecosystem. And this is the way I tell everyone, don't buy companies on crypto or the blockchain, buy the tokens. And Bitcoin should be 70% of it, and then go figure out what else you want in that, but just always make it that. And you don't need to do all this analysis on bringing in companies and funds. To be honest with you, didn't Steve Jobs make a bet on people buying technology and getting it? I mean, the iPod was a huge risk, and there were other competitors. And I still remember going to the Apple store going, wow, this place is beautiful. He bet on people seeing beauty. He bet on that, and he levered his company to some degree by spending money on it and investing in this. And a lot of people didn't believe in it. He also made the leverage on the smartphone. And a lot of people didn't believe in that. So I think what he's doing is the new innovation. It's just that because you're not doing it on a product, you're doing it on the actual innovation. I could make the argument that what he's doing makes a lot of sense and could be compared in a very, very loose way to what Steve Jobs did.
I always say to people, you get wealthy through leverage, equity, and concentration, right?
Yeah.
That's how you create a lot of wealth. And, but if you already have wealth, you want to diversify.
Yeah.
Jordi, I just want to be very respectful of your time. I think we should wrap up here. We're at about an hour. I want to thank you very much for coming on the show today, sharing your background, your thoughts, your macro thoughts on the markets, as well as Bitcoin and Web3. So if you could just tell everybody where they can find you and your podcast and your company, that'd be great.
Yeah, the company website is gweiss.com, gweiss.com. The podcast that I do is In Search of Green Marbles, and it's on every place. It comes out once a week. We keep it to 15 to 30 minutes. For those of you who are mainly on the crypto side, I spend a lot of time in these just kind of giving people views on the markets. Everything will be on there. And then I do webinars, which are about 15 to 25 minutes. I'll be doing one tomorrow. Those are on the website, and those are meant to give about 15 to 30 charts in 15 to 25 minutes, where I kind of take people through where inflation is, where the economy is, and where my views are going to be. So you can find me at any of those places. And I just started tweeting last week from demand from people after the podcast had started, just to get real-time views out. So I send out some market stuff on there, and then I will be doing a major Kentucky Derby piece, which I do every year. It'll be on the website in the next 2 weeks.
Now, I will tell you this. You were introduced to me from one of my old angel investors in one of my companies I sold. This guy, Bill, he worked at Alliance Bernstein. They had like $17 billion AUM. He was under this guy, Kurt. And he introduced your podcast to me a while back because, he's a macro guy, obviously. Yep. 35 plus years, Wall Street. He's retired now in his early 60s. I love getting the perspective and I think Bitcoiners should do the same because it is correlated. It is not uncorrelated. It's not decoupled from the NASDAQ and growth, right? So you should understand what's going on in the markets, but also you really shouldn't trade this stuff anyway. Just buy it, hold it, forget about it, own a small percentage. When you tell clients that they should buy Bitcoin, as you said, 70-20, what percentage of net worth would you suggest, by the way, for people when they do that? Just curious.
So depending on the age, like minimum of 5%, but I tell everyone at this point, my conviction is so high on this movement that it should be at least 10, depending on how much risk you want to take. I got to make sure people hear this because you don't hear this too much from macro people. So I spend all my time on this Ponzi scheme fiat system, and everyone has to understand that it is a Ponzi scheme.
That's right.
And so we have 500 trillion in global assets at this point. The total size of the crypto market is still less than 3 trillion. Mm-hmm. The reason this is a high conviction thing for me is that every day there will be money leaving that fiat system and coming over here. They're going to run parallel for some time. There is no way at this stage that you can't make up a better period of time for crypto to do well, which is why my conviction is so high for this year. Everything happening in China, everything happening in Russia, Ukraine, everything that happened with us printing money has just enabled that we cannot cause recessions. We cannot deal with recessions. We have to have this money going somewhere. And it's the talent that continues to migrate into this ecosystem, and they take their money with it. And they're going to have 20 to 50% of their money in there the same way Michael Saylor does. So gradually this movement will keep bringing more money into it. And as people get up to 5, 10, 12%, it's just starting, guys. It is just starting.
I couldn't agree more. Back to that guy that I was telling you about, Bill, and he's probably listening to this one for sure. I had a smaller percentage of allocation. Obviously, with the growth of Bitcoin since 2016, it's grown substantially. He keeps telling me rebalance. I'm like, why would I do that? My investment's done really well. Do you advise to not rebalance, or do you advise to rebalance?
Yeah, everyone who has followed that has complained to me the same thing, which is a good complaint because when Ethereum goes up 400% in a year, and I sit there and go, do you realize that it took, and this is a true stat too, it took Amazon from 2009 to 2017 to go up as much in terms of market cap as Ethereum did from November of, I guess it was 20 to 21, because it went up like $400 billion. And that's how long it took Amazon to do that. I tell them, just keep it in there. Don't view it as a spending thing. Just keep living your life in this other world and let that stuff go.
Forget it.
It's going to keep going.
Just forget about it. You listen to that, Bill? Forget about it. Okay, Jordi, thanks for coming on the show. I appreciate you spending your time with me today. If you guys enjoyed the show and you're somebody who's following Jordi and you want to hear more views about Bitcoin and stuff, you could always subscribe to my channel as well. Thanks again, Jordi.
Thanks, Jay. Appreciate it.